Hello, and thanks for joining us. Mark and Sarah here from the HireWire podcast.
Hello, everyone.
Today, we're going to explore some really valuable analysis for anyone in recruiting. It's from industry expert Bob Marshall, looking at the latest labor market data from May 2025.
That's right. Bob's known for cutting through the complexity in these reports, doesn't he? He really zeroes in on what matters for recruiters.
He does. And he's pulling from all the key sources here. The Bureau of Labor Statistics, the BLS.
The ADP National Employment Report, the Fed's Beige Book, and also the Conference Board's Help Wanted Online Index.
So our goal here is to unpack what Bob found in those sources. We want to pull out the key things that can help you, our listeners, understand and maybe navigate this current hiring landscape a bit better.
Okay, so where should we start? Maybe the big picture. The May 2025 numbers.
Sounds good. Let's look at the official BLS report first. What were those top-line numbers?
The BLS said total non-farm payroll employment went up by 139,000 in May.
139,000. And the overall unemployment rate?
That didn't change, stayed at 4.2%.
But there were revisions to earlier months, weren't there? That seems important.
Yes, definitely. The BLS revised March downward quite a bit by 65,000 jobs. It went from plus 185,000 originally down to plus 120,000.
Wow.
And April was also revised down by 30,000, from plus 177,000 down to plus 147,000. So if you combine those, that's 95,000 fewer jobs created in March and April than we initially thought.
Right, so maybe the momentum wasn't quite as strong in the spring as the first report suggested. Okay, how did the ADP report compare for May? That one covers the private sector, right?
Correct. And the ADP number was, well, much lower. It showed private sector employment increased by only 37,000 jobs in May.
Only 37,000.
Yeah. And Bob points out this is actually the slowest pace of private sector hiring ADP has reported since way back in March 2023.
That definitely signals a slowdown, at least in the private sector, according to ADP. What about pay? Did ADP give insights there?
It did. Annual pay growth was pretty much unchanged in May, according to their data. For people staying in their jobs, year-over-year pay growth was 4.5%.
4.5%. And for job changers?
For job changers, pay growth was 7%, which was the same as in April. So stable, but still higher for those making a move.
Okay. Now, beyond just the numbers, the Federal Reserve's Beige Book gives more of a feel for the mood out there, right? It came out early June, covering activity since late April. What was the main takeaway Bob highlighted?
The really striking thing from the Beige Book across all the Fed districts was this pervasive sense of, well, caution. Elevated levels of economic and policy uncertainty were reported everywhere.
And you have to assume that uncertainty affects hiring plans.
Absolutely. The report specifically links that uncertainty to businesses being hesitant, taking a more cautious approach. Employment overall was described as mostly steady.
Mostly steady.
Though there were slight increases in places like Chicago, Cleveland, Richmond, but also slight declines in Boston and Philadelphia. So a mixed bag, but generally stable to cautious.
For recruiters listening, the comments on actual labor demand are probably key.
Oh.
What did the Beige Book say about staffing plans because of this uncertainty?
There were lots of comments saying uncertainty was directly delaying hiring. Districts mentioned lower labor demand generally, citing things like fewer hours worked, less overtime, actual hiring pauses, and even plans for staff reductions.
Were there any specific examples that kind of illustrate this?
Yes. Quite a few telling ones. In Boston, staffing contacts said employers were delaying hiring, and they specifically mentioned tariff uncertainty as one reason.
Interesting.
Those same Boston firms noted that starting pay was mostly stable, but pay rates for experienced hires actually went down moderately for some roles.
Went down.
Out in Minneapolis, one staffing firm reported a really sharp drop. 30% fewer job orders compared to the same time last year.
30%, that's significant.
It is. And in Dallas, a headhunting firm mentions several clients had put senior manager offers on hold. Just pause them.
Those examples really paint a picture of how that general uncertainty translates into real-world hiring slowdowns. Wasn't there also something about a manufacturer changing their workforce mix?
That's right, in the St. Louis district. One manufacturer was reported to be cutting back on temporary workers but actually hiring more full-time staff. So maybe some companies are rethinking their temp-to-perm ratio in this climate.
Okay, let's shift gears and look at where the job changes happened. Can we break down the ADP data by industry and maybe business size?
Definitely. Looking at the ADP private sector by industry, the goods producing side actually contracted slightly, down 2,000 jobs overall.
So where were the losses there?
Mainly natural resources and mining, down 5,000, and manufacturing, down 3,000. Construction, though, did add about 6,000 jobs.
So mining and manufacturing pulling it down. What about the service providing sectors? That's usually the engine.
It was positive overall, adding 36,000 jobs. The big drivers were leisure and hospitality, up 38,000.
Makes sense.
Financial activities up 20,000, and information up 8,000. But, and this is important, for many recruiters, there were some notable decreases. Professional and business services saw a big drop, down 17,000.
Ouch, minus 17K in ProBiz services.
Yeah. And education and health services down 13,000, trade, transportation, utilities down 4,000.
That drop in professional business services certainly stands out. Now, what about by company size? Bob Marshall often emphasizes this breakdown.
This is really fascinating. Small businesses, the ones with 1 to 49 employees, they actually lost 13,000 jobs, according to ADP.
Lost jobs. Okay.
And large establishments, 500 plus employees. They also saw a small decrease, down 3,000 jobs.
So, if small and large businesses both shed jobs, where did the overall gain of 37,000 come from?
Almost entirely from medium-sized businesses. Those with 50 to 499 employees, they added a strong 49,000 jobs.
Really?
And drilling down even further, the segment with 50 to 249 employees added 51,000. So basically, that mid-sized group accounted for pretty much all the net private sector growth ADP reported for May.
And that connects directly to what Bob Marshall often talks about, doesn't it?
Exactly. He consistently points out that many recruiters, especially in contingency search, really focus on small and medium-sized companies. This ADP data seems to underline that those mid-sized firms were showing resilience in May, even when the very small and very large weren't growing.
Very interesting. Okay, let's turn to the JOLTS report, Job Openings and Labor Turnover Survey. This data is for April, released in early June. What did it show about openings and churn?
The April JOLTS report showed the number of job openings was, well, little changed really. It stood at 7.4 million. That's an openings rate of 4.4%.
7.4 million openings. Any major shifts between industries?
Some movement. Openings went down in accommodation, food services, and state local government education, but they increased in arts, entertainment, free creation, and also mining logging.
And what about actual hires and separations?
Also little changed according to the report. Hires were at 5.6 million. That's a 3.5% rate. Total separations, people leaving jobs for any reason, were 5.3 million, a 3.3% rate.
Within separations, how do quits and layoffs look?
Quits, that's people leaving voluntarily, were also little changed in April, at 3.2 million, a 2.0% rate. But Bob notes that quits are down by 220,000 compared to a year ago, maybe suggests a bit less confidence in jumping ship voluntarily.
Possibly. And layoffs.
Layoffs and discharges, the involuntary separations, were pretty steady too at 1.8 million, a 1.1% rate.
Now, Bob Marshall always provides a really crucial interpretation of that headline JOLTS number, the 7.4 million openings. What's his take?
Yes, this is so important for recruiters. Bob emphasizes that the 7.4 million JOLTS figure, that only counts the published visible job openings, the ones you see posted online.
Oh, the advertised one.
His analysis suggests this represents only about 20%, just 1/5 of the total job market. The other 80% are essentially hidden jobs. They get filled through networking, internal moves, referrals, or through recruiters who can find people who aren't looking at job boards.
So if 7.4 million is just 20%, what does that imply for the total number of opportunities out there, published and hidden?
Bob's calculation is straightforward. If 7.4 million is 20%, then the total market size is 5 times that. Around 37 million potential job orders out there.
37 million.
It's a massive number.
Yeah.
And it really highlights the value recruiters bring, right? Accessing that huge hidden market where relationships and proactive searching are key.
Definitely puts things in perspective. Let's quickly touch on another data point. The Conference Board's Help Wanted Online Index, the HWAL, that also tracks job ads, but just online ones. What did it show for April?
The HWAL index did tick up slightly in April, reaching 111.2 after a dip in March. It's designed to measure monthly trends in online job vacancies. They do revise it annually, incorporating other data like JOLTS now too.
But even with that slight April increase, how does it look compared to last year?
It's still down. The index is 4.5% lower than it was in April 2024. So despite the monthly bump, the overall trend for online advertised jobs over the year is still negative. Fewer online postings than a year ago.
Okay. Let's circle back to unemployment now, but focus specifically on the candidates that recruiters are typically trying to place. We know the main U3 rate was 4.2%. What about the broader U6 measure?
Right. U6 includes people marginally attached or working part-time when they want full-time. That rate was 7.8% in May. It's up a bit from 7.4% in May of last year.
And there were some interesting movements in the labor force itself.
Yeah, pretty significant shifts. The civilian labor force actually decreased by 625,000 between April and May, though compared to last year, it's up by over 2.7 million.
A decrease month over month. What about the number unemployed?
That went up slightly from April by 71,000, and it's up 602,000 over the year. But the really striking number is the not in labor force category.
How many people were you talking
That
about?
jumped to over 102.8 million people. That's an increase of 813,000 just from April, and up over 2.4 million compared to May 2024.
Over 102 million not in the labor force? That's huge. What does that do to the participation rate?
It dragged the employment participation rate down to 62.4%. Bob points out this matches lows we haven't seen since September 2015, and before that, way back in October 1977. It raises that question Bob often asks. How are all these people sustaining themselves without income from work?
A very valid question. But okay, setting aside the overall picture, Bob Marshall's key insight for recruiters comes when you look at unemployment for the specific groups they target.
Exactly.
Yeah.
This is critical. Recruiters are mostly placing management, professional, and related workers, and often those with college degrees. So when you look at the May unemployment rates just for those groups, it's a totally different story.
What were the rates?
For the management, professional, and related occupational category, the unemployment rate in May was just 2.4%.
2.4%.
And for workers with a bachelor's degree or higher, it was 2.6%.
Wow. Compare that to the overall 4.2%. That's a huge difference.
It's night and day, and Bob's analysis, looking at historical data too, shows these rates 2.4% and 2.6% are exceptionally low for these specific high-demand talent pools.
This brings in that idea of the natural rate of unemployment, doesn't it?
It does. It gives crucial context. Economic theory, like from Milton Friedman, talks about NAIR IRU, the non-accelerating inflation rate of unemployment. It suggests there's always some baseline unemployment, maybe 4% to 6%, in a healthy economy due to job transitions, new grads, etc. Zero unemployment isn't really feasible or even desirable in a dynamic system.
So if the natural rate is maybe 4.6%, and we're seeing 2.4% and 2.6% for these professional groups,
Bob's conclusion is pretty stark. For the specific talent pools recruiters are going after, unemployment is effectively zero. It's well below that natural friction level. The available pool of unemployed experienced professionals is tiny.
he also mentioned Henry Hazlitt's perspective.
Right, from Economics in One Lesson. Hazlitt argued the goal is maximizing production and full employment is a byproduct. You can have everyone employed but not be producing efficiently. Bob uses this to say just looking at a low overall unemployment rate doesn't mean you have the right skilled people available where needed.
And even within that tiny 2.4 or 2.6%, those individuals might not be the ideal candidates recruiters are looking for.
That's a really practical point Bob makes. Who makes up that small percentage? It often includes transient folks, job hoppers, maybe people harder to place, or those just testing the waters. Recruiters, as you know, are usually hired to find successful, currently employed, well-compensated people and entice them with a better opportunity. They aren't just filling roles from the small pool of actively unemployed professionals.
So, pulling it all together, the message for recruiters seems pretty clear, despite some confusing signals in the broader economy.
It's unambiguous, based on Bob's analysis. Yes, there's caution. Yes, overall growth slowed. Yes, some sectors are down. But for the core talent management, professional, college-degreed individuals, unemployment is incredibly tight, effectively zero. Which means for recruiters, it's not about finding unemployed people, it's about actively marketing to get good job orders and proactively recruiting passive candidates, because the active available pool is so shallow.
Makes sense. Let's just quickly add the GDP context. What did the latest estimate for the first quarter of 2025 show?
The update for Q1 GDP, covering January to March, showed the economy actually decreased slightly at an annual rate of 0.2%. That was a downturn from the 2.4% growth in the last quarter of 2024.
What caused the decrease?
Main factors were more imports, which subtract from GDP, and less government spending. There were some offsets from increases in investment, consumer spending, and exports, but the net result was a slight contraction. It points to a slowing economy overall.
And typically, GDP changes tend to lead unemployment changes, right? Usually with a lag.
Historically, that's been the pattern. Slower GDP growth often precedes a rise in unemployment down the line.
Okay, so let's summarize the key takeaways from Bob Marshall's May analysis for everyone listening.
I think the big picture is the economy's showing clear signs of caution. Hiring is hesitant in some areas, seen in the slower ADP BLS numbers and the Beige Book comments, especially hitting temps in sectors like professional services.
But, and this is the critical point from Bob's work, despite those headlines, when you drill down into the specific talent pools that recruiters serve, the professional and college-degreed candidates, the data shows unemployment is extremely, extremely low.
And don't forget that Joltest's insight, the published 7.4 million openings, are likely just the tip of the iceberg, maybe 20%, implying a huge hidden market of around 37 million opportunities where recruiters are essential.
Bob Marshall really does provide such clear, actionable insights from these complex numbers for the recruiting world. We really appreciate him sharing this kind of breakdown.
It's vital information for making good decisions in this market.
Absolutely. So maybe a final thought for you to consider as you go about your week.
Yeah.
Given this environment, the broader economic uncertainty, but combined with this incredibly tight market for the high-skilled talent you target, plus that large hidden job market, how does that change the conversations you need to have with your clients, with your candidates, thinking about talent strategy, availability, and of course, market value right now?
Definitely something worth reflecting on as you plan your approach.
Thanks so much for tuning in. We're Mark and Sarah from the Hirewire podcast. We'll talk to you again soon.